it now seems fairly clear that the Federal Reserve, at least, is pursuing now a more aggressive easing policy. And that was foreshadowed by the statement that Chairman Powell made at the Jackson Hole Summit a few days ago. So basically, Powell said, number one, that inflation is pretty much beaten. Number two, that employment or maintaining employment, avoiding unemployment, was now a bigger criterion for the Federal Reserve to start watching. And the third thing that they said was that interest rates cuts are coming. So all those things are pretty good for markets. And I think once you add up the general shape of what the economy looks like, you've got three major factors, I think, to look at, which makes me pretty upbeat. I mean, number one is that the Federal Reserve wants to ease. Number two, you've got a sluggish economy in the US, and sluggish economies that need to be stimulated are normally good for liquidity. So in other words, policymakers will start pushing a lot more cash into markets. And the third thing is we've got a lid on inflation pressures, certainly in the short term, because China is suffering deflation and it's trying to export its way out of deflation, which basically means that the world economy enjoys low or even falling prices. So you've got a backdrop here, which I think looks pretty good for financial assets for the next few months.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Michael Howell. So Michael's the founder and managing director of CrossBorder Capital and sort of one of the at the forefront of liquidity in the economy and markets overall. So Michael, thanks so much for coming on the podcast today.
Great. Good to be here, Anthony. Looking forward to it.
Yeah, looking forward to it too, because last time we spoke, it was sort of around March. And I think at that point you mentioned in the real short term, 4 to 8 weeks, you expected there would be market turbulence with the tax season and sort of other factors there as well. And then after that, you was sort of saying the mid, time period going into the end of 2025, you thought that'd be very positive for liquidity. So, have we gotten through that turbulence? Is it clear flying now? What are you currently seeing?
Well, I think the answer is that what we had was in the wake of the maybe it was Q2, I think was the danger point. And what we saw in Q2 was basically liquidity at best flatlining and probably in some cases actually falling. Two events were really paramount. One was, if you look at the Federal Reserve balance sheet, the Federal Reserve balance sheet was under downward pressure. In fact, let's be more specific and look at liquidity injections. Liquidity injections by the Fed basically came off a bit. And that was largely because of a phenomena which saw the tax take. It was tax paying season in the US, and the tax take basically bloated the Treasury general account, which is basically a deposit account, if you like, for want of a better description, held at the Federal Reserve by the US Treasury. So the Treasury was accumulating cash, and that cash was basically coming out of money markets. And so liquidity in the US system was challenged through that period. The other thing that was significant was that the People's Bank of China, in the wake of the Lunar New Year holiday, began to tighten monetary policy quite aggressively. And those two acts basically created a liquidity air pocket in markets. And that's why we've had, if you like, a fairly difficult Q2 and maybe Q3 so far. I think if we look forward into the back end of this year and probably into 2025, it now seems fairly clear that the Federal Reserve, at least, is pursuing now a more aggressive easing policy. And that was foreshadowed by the statement that Chairman Powell made at the Jackson Hole Summit a few days ago. So basically, Powell said, number one, that inflation is pretty much beaten. Number two, that employment or maintaining employment, avoiding unemployment, was now a bigger criterion for the Federal Reserve to start watching. And the third thing that they said was that interest rates cuts are coming. So all those things are pretty good for markets. And I think once you add up the general shape of what the economy looks like, you've got three major factors, I think, to look at, which makes me pretty upbeat. I mean, number one is that the Federal Reserve wants to ease. Number two, you've got a sluggish economy in the US, and sluggish economies that need to be stimulated are normally good for liquidity. So in other words, policymakers will start pushing a lot more cash into markets. And the third thing is we've got a lid on inflation pressures, certainly in the short term, because China is suffering deflation and it's trying to export its way out of deflation, which basically means that the world economy enjoys low or even falling prices. So you've got a backdrop here, which I think looks pretty good for financial assets for the next few months.
Okay, so those are the key, I think, things that you're watching at currently for liquidity. Is there anything else that we should be paying attention to?
Yeah, I think there is another factor, and that other factor is probably to join those dots together, is to say what is maybe in the background here is that one of the reasons the Federal Reserve is easing and the timing of that easing is not just the fact that inflation has been beaten. It's probably also a more general factor, which is that they want to try and get the US dollar down. Now, a strong US dollar is a negative for global liquidity. It puts a lot of pressure on foreign economies, particularly through the exchange rate. So if the dollar is strong, other countries are struggling to keep their currencies really in line with the US, and therefore they have to tighten monetary policy, or at least they can't afford to ease too much. And China and Japan have really been in the forefront of that. In actual fact, if you look back to a date back in 2016, there was something there that came out of a G20 summit, which was the so-called Shanghai Accord. Now, the Shanghai Accord was not a formal agreement. It wasn't in the media, or at least it wasn't in the media at the time. It subsequently sort of appeared in terms of rumors, and this is what many journalists are suggesting actually went on at Shanghai in early 2016. And it was really an accord to try and make sure that Asian currencies remained stable against then what was a strong US dollar. Now, lo and behold, they did. And if you look at the period from 2016 right through until early 2022, there was a remarkable degree of stability across Asian units vis-a-vis the US dollar. And monetary policy was generally tightened whenever the US dollar got too strong by these Asian countries. Now, that was a liquidity sapping event. It wasn't bullish for liquidity in the global economy. It was overridden, as we know, by the COVID crisis, but nonetheless, that was in the background. And the problem is that it's been putting a lot of pressure on both the Japanese and on the Chinese economies, China in particular. And it's caused the Chinese to tighten monetary policy unduly, which is the reason that the Chinese economy has never really lifted out of the COVID troubles. It's always sort of stuttered or spluttered in the wake of that. And that's largely because the PBOC has had tight policy. Now, the reason for citing this and the reason for examining the reasons why we may be getting a weaker dollar now is that perhaps there was some renewed accord or agreement done between the Americans, the Japanese, and the Chinese. There may have been some quid pro quo, perhaps, and we don't know what that is, but it could have been related to the US Treasury market. It may have been related to Ukraine, support for Russia, who knows? But something has been done, I suspect, which is why you've seen the US dollar actually begin to weaken quite noticeably over the last few weeks. So much so that if you look at the DXY, the trade weighted index, it's come rattling down from about 106 to now almost 100. I think it's going to go lower. I think it's going to test 95 at least. And that is, a meaningful, perhaps a 10% or so devaluation of the dollar on its trade weighted index over that period. Now, the backdrop of that is if you're getting a weaker dollar, you get two factors which really come in as well. Number one is that it gives the ability to foreign governments to ease monetary policy as well. And the other thing it does is it basically boosts the attractions of what we call monetary inflation hedges, which are things like gold and Bitcoin. So you should be seeing generalized easing through the world. And you should also see these monetary inflation hedges like gold and Bitcoin starting to make new all-time highs. And that's the backdrop we've got. Now, whether this is parallels a previous instance where the Americans wanted to get the US dollar, a strong US dollar down, which was the 1985 Plaza Accord, who knows? But it's certainly treading in that direction. Even if it's smaller in scale, I think the direction counts. So I would suggest that this is a weaker dollar and stronger liquidity environment that is coming on top of what we know are rate cuts in the wake of some success over global inflation.
Have you been surprised, I guess, by how much the dollar's come down? Because it seems like, you mentioned there that they're starting to cut, but it seems like all central banks are going the same direction as well. So it's not really as if they're, that far ahead of everyone else.
Well, I think markets are probably looking forward. And I think the scale by which the US has been lagging in terms of what other central banks have been doing up to now. And I think the sort of tenor of what Chairman Powell was saying the other day was that the US is likely to embark on quite aggressive policy easing. Certainly, if their benchmark is to maintain current levels of employment, they may have to cut interest rates or boost liquidity quite significantly. And therefore, the dollar is really responding to that.
And do you think that's different in, I guess, other economies such as, in Europe, in the UK, because it seems like they've sort of gone up quite a lot compared to the dollar?
I mean, the fact is that what we've had for much of the last decade or so is a very strong US dollar, and there's no mistaking that. And that is not a great recipe for strong growth in the world economy, neither is it a particularly good background for liquidity. And now you've got the dollar coming down. I think that's generally bullish. The scale of the retracement of the dollar, could be, significant. I think it's probably of the order of about 10% or so. But is that a surprise? I don't think so necessarily. Given the fact that generally at this stage of the cycle, not least, the dollar tends to weaken anyway as the world economy begins to pick up. So I don't think we're seeing. I mean, I think generally in a lot of market movements right now, we're not seeing anything which is particularly unusual. We're seeing liquidity expand. We're seeing the world economy beginning to bottom out. We're seeing yield curves steepening. We're seeing the US dollar begin to weaken. So this is a pattern that you would normally expect. And, I'd remind you, after all, is that bull markets always climb a wall of worry. And, so many people are saying there's a crash around the corner. There's a recession, deep recession coming. But I mean, for heaven's sake, they've been saying that for much of the last 2 years. So I didn't see that anything has changed particularly.
Yeah, and is this could this also be linked to, a few weeks ago we saw this aggressive unwinding of the well, apparently a small unwinding of the yen dollar trade, as well as short volatility. Do you think this is a trend that's probably going to continue, and that could also be a factor that's, I guess, weakening the dollar as people sell out of that and sort of buy yen to close their debt positions?
Well, I think the thing to stress is that if you look at what happened with the so-called unwinding of this yen carry trade, is that this was not a liquidity destroying event. And I think you can see that if you look at the first chart that I put up, if you can show that on the screen, Anthony. What that illustrates is the global liquidity cycle. Now, this is one of two big moving parts that we look at, which really drive markets. So this is the flow of new money that's going into those markets. And as you can see that this is a long-term chart, admittedly. It gives data up to the end of last month, but it basically shows that what you've got is a still rising cyclical trend on the chart. The black line is actual readings of global liquidity, which is taken across 90 economies worldwide. This is the amount of liquidity that is traveling through their financial markets, and that tends to be cyclical, and it follows a path that is hypothesized by that red dotted line, which is a sine wave that we put on top of the chart. Now, just to maybe underscore the fact we're not cheating here, that red line was actually estimated over the period from 1970 to year 2000. So it's been simply extrapolated using that same frequency since year 2000. And it seems to be pretty much matching the current cycle. And that's why we think the cycle bottomed in October of 22 and will likely peak out sometime in late 2025. Now, liquidity is a major engine of the world economy and a major engine of global liquidity, of market movements. But it's only one of two big moving parts. And the other is not just the flow of liquidity, but how that liquidity is deployed across risk assets by investors. In other words, the second bit is an asset allocation decision. And if you look at the following chart, what that illustrates there is shows two lines. The orange line is the risk exposure of investors in all markets worldwide. So it's global investors. And it's showing an index which is based around 0, which is normal portfolio allocation. And the graduations, 20 is one standard deviation above, or one standard deviation, minus 20 is one standard deviation below, normal asset allocation into or out of risk assets. So what you saw on the orange line coming into this crisis was that investors were, broadly speaking, just over one standard deviation above normal risk exposure. Now, that risk exposure tends to correlate quite closely with the tempo of the world economy, and that's shown in black. So the black line is a measure of all business confidence surveys worldwide. So it's things like the US ISM Purchasing Managers Index, it's things like the UK CBI survey, the Japanese Tenkan, etc. aggregated together and weighted by economy size, and that shows up as a black line. So that's a measure, a benchmark of what the world economy is doing. So what you would normally expect is that risk exposure, broadly speaking, matches that black line. Now you can see that really coming into this crisis or this sell-off, risk exposure was elevated relative to the tempo of the economy. It's now come back in line. Now, if we look forward, what I would argue is that the yen carry unwind is a risk event. In other words, it caused investors to push their portfolio exposure down away from risk assets into safer assets, maybe like bonds, maybe like cash, maybe like gold. And if you look forward on the basis that liquidity is expanding, so the first moving part is going up, and the world economy is beginning to bottom out here, you would expect risk exposure, the second moving part, to also begin to stabilize and probably pick up. And since we drew this chart, which was basically the end of the first week of August, risk exposure has since picked up, and it looks as if the tempo of the world economy is a lot better. So generally speaking, looking ahead, this looks fine. You're going to get rising asset markets. Now, the only caution I throw into that is that what we've already had is a pretty decent rally in risk asset markets, really since the bottom in late 2022. So probably, based on past criterion, I would suggest that we may have seen already 2/3 of the gains through this bull market. We've still got a third to go, and you can still make a lot of money by rotation into sort of mid-cycle stocks, maybe taking more financials, taking more commodity exposure, these sorts of things, and maybe moving out of some of the early winners. But generally speaking, the outlook still looks to be pretty good as far as we can see.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. That's interesting. So even though, if we go back to this chart, even though we're only sort of just coming off the lows in liquidity, or I guess it's been happening for a year, but it's still sort of quite low, that's where the majority of the returns. Is that sort of what you generally see in the past cycles, that majority of returns occur off this sort of first bounce from the bottom?
Yeah, it's like the early stages of the market tend to be, what we call the rebound phase tends to be quite an exciting phase. And I made the point that bull markets normally climb a wall of worry, and that wall of worry is certainly very steep in the early stages of the bull market. So it's not unusual. Bull markets last, the whole cycle lasts about 5 to 6 years, and the bull market expansion is probably about just over 3 years of that. So you can see in terms of the timeline, we've already had quite a lot of that expansion. So it's, I don't want to over egg it, but I think we've got further to go for markets. I wouldn't be surprised to see another 10-15% over the next 12 months. But we're getting towards the end of the bull market. Maybe it lasts for another 12 months or so, but it's still pretty decent returns.
Yeah, and I know you mentioned sort of, I think in a previous interview, sort of at the end of 2025, you think Yellen may be pushed into sort of some decisions because of, I guess the sort of fiscal position, the lots of debt. Can you maybe expand into that and why you think that may be the case, or what do you think will happen?
Yeah, well, I think that the first thing to say is it may not be Yellen, of course, who's making those
Yeah.
decisions, but let's see. The other thing is to differentiate the cycle from the trend here. And if you start to look at what's going on fiscally in the US, then you really start to worry about how robust maybe financial asset markets are, or conventional financial assets. Now, we've always thought about bond markets. Well, we've thought for the last 30, 40 years, bond markets being the safe asset, particularly the US Treasury. I think the point being is that that is certainly true if you're in a disinflationary or low inflationary environment. If you're in a higher inflationary environment, it's not entirely clear that bond markets, and particularly treasuries, are the safe asset anymore. Now, legislators and regulators may want treasuries to be the safe asset, and they may dictate that they are the safe asset legally for banks and insurance companies. But for the average investor who's not is not compelled to follow those guidelines, maybe start to look at other assets. And if you go back to the inflationary 1970s, it was things like commodities, gold, real assets that were actually much better safe assets in a higher inflationary environment. One of the things to look at is the extent to which bond markets and stock markets are correlated on the way up and the way down during periods of high inflation. Their correlations tend to go up. So bonds are not a diversifying asset during those periods. And bonds in particular tend to be quite poor performers. So I think that's one of the things that we've got to start thinking about. The other thing is that, against this background, to try and put numbers on this, are we looking at a seriously much higher rate of inflation in the world economy than maybe people are judging? Now, I would suggest that it's not radically higher, but it's sufficiently higher to actually warrant some concern about conventional asset allocation. And that tells me that the 60-40 model of equities bonds is not the right one to have. And you should be diversifying more into things like gold and probably cryptocurrencies, notably Bitcoin, as some way of hedging that. Now, if you look at the US break-even inflation market, which is a way of judging long-term inflation trends, although my comment's going to be probably slightly wonkish, the problem is that if you look at the break-even inflation rate from the TIPS market, which is something you can actually work out by stripping the yield on the TIPS, the Treasury Inflation Protected Security, the index-linked bond, from conventional bond yields, you get a number there which is suggesting that US inflation, long-term inflation, has already come down to about 2%. Now, that is probably the wrong figure. And the reason I say it's the wrong figure is the Treasury market itself looks to be very distorted by what the US Treasury is doing. Now, I don't know whether we can move to the slides and move a little bit further along, and I can try and adjust, or I can adjust these, Anthony. So if I go along here a bit more, let me go back one. Right. This is the thing to start thinking about what the Treasury is doing in the US. And this, as I said, is somewhat wonkish, but because it's wonkish, it doesn't necessarily mean that you shouldn't try and understand it, because it's very important. And this is showing the composition of US debt issuance. Now, this is showing the proportion of Treasury bills, which are very short-dated debt, up to 1 year. They don't pay a coupon interest rate. They basically are securities that redeem at par. So what this is showing is that the percentage of bills that are being issued by the US Treasury is on an upward path. Now, the long-term guidelines that many experts or pundits have thought about is a range of between about 15 and 20%. Now, we're above that, and it looks to me as we're moving towards, remorselessly, towards a level of nearer 25%. Now, why is this a particularly important factor? It's important in two dimensions. One is that the question to ask is who buys these bills? And bills tend to be bought much more by banks and generally by credit providers. And if banks and credit providers are buying government debt, that technically is monetization. So it's the equivalent of printing money. So the very fact that they're issuing Treasury bills, and slightly beyond that, they're also, in terms of their coupon issuance, skewing the issuance of coupons towards shorter dated bonds. So in other words, what I would say is, to wrap this up, there's active duration management going on by the Treasury here, and they're skewing issuance away from longer dated coupons towards these shorter tenors. Now, what that means is that there is a distortion in the Treasury market. And as I keep saying, this is wonkish, but it's really very important. And what this shows is, if you look at this graph, it shows what I've called the true risk-free rate, okay? And that's the red line, which is measuring what you would infer the Treasury yield to be if you benchmark or bootstrap the Treasury yield from the agency mortgage market. So what we've done here is that we've adjusted agency mortgages. Now, agency mortgages are basically mortgages that are issued by Freddie Mae, Freddie Mac, the so-called government-sponsored enterprises in the US. They're a government-backed instrument, so they're like a risk-free Treasury, but they're a truer guide right now to what the yield on the 10-year should be. And you can bootstrap this implied yield or synthetic yield from the agency mortgage market, which is shown in red. So what that's telling us is actually that if you look at the degree of or the yields on the US Treasury market, they should be nearer 5% right now than the nearer 4% that we're looking at actually in reality. So there's 100 basis point spread, at least 100 basis point spread between actual yields and what fair value yields should actually be. Now, that's a puzzle, and it explains an awful lot of the anomalies in markets, such as why the yield curve is inverted and why the yield curve has never been a great predictor this cycle for recession or whatever. I mean, as you will recall, a lot of pundits in the US have been saying for a long, long time, this inverted yield curve is going to cause recession. It's what it's signaling. Okay, and there's various nuances people put on that. So when the yield curve begins to steepen, as it is now, they say, well, that's always a sign that recession is about to hit. Well, wrong. The yield curve has always been a flaky predictor anyway, but it's really distorted now, because if you put into your calculation of the yield curve this fair value yield that I've calculated, not the actual Treasury yield, you'd find that the yield curve never inverted at all. In actual fact, it's stayed positive and it's starting to steepen. Now, why is that going on? And if I can shift to this next slide, this is the reason that you've got this feature going on. The black line is the growth rate. The black line is the yield suppression that you're getting in the Treasury market. It's happened before. So you've got 105 basis points or so of yield suppression now on that right-hand chart, which is telling us in black and white terms that the yield on the US Treasury bond, the most important yield worldwide in financial markets, is about 100 basis points, in other words, 1 percentage point below where it should be. Okay, so there is the active yield suppression going on, and that active yield suppression is because Treasury issuance has been skewed towards the front end of the curve. In other words, there's been a lot of Treasury bill issuance, a lot of short-dated coupon issuance. And you can see the correlation between those two lines. Very similar thing happened in 2008 with the global financial crisis, where yields were suppressed by big bill issuance then, as the Treasury embarked on huge spending and had to finance it very quickly. So again, you saw in the COVID crisis very similar features, and we're seeing it again now. Now, what does that mean? As I said, it means that the yield curve is distorted. It means that the Treasury is issuing a lot of short-dated debt. That is liquidity creating by definition. And the third thing that comes into this is that if you look at this chart, which is maybe the more worrying of the lot, it basically shows two calculations of future inflation in the US. Now, the orange line is what the break-even Treasury inflation protected security market is telling us. So that's the break-even inflation rate, the implied inflation rate that the bond markets are assuming right now. And you can see that it's basically very close to 2%, which is exactly the criteria that, or the benchmark that the Federal Reserve have targeted. And this is giving Chairman Powell great comfort to say, I'm going to cut interest rates. And he will. The black line is the University of Michigan Consumer Survey, which is basically saying what do consumers expect inflation to be over the next few years. And that, or both those two criteria are on the measured on that left-hand scale. Now, the dotted line is our estimate of the true break-even inflation from the TIPS market if you use this new calculation for Treasury yields, not the one that's actually prevailing. And you can see there that the dotted red line is much more in line with the Michigan survey. It's suggesting what you're likely to see is 3 to 3.5% long-term inflation. So this is not hyperinflation by any means. But what this is basically saying is that you're not getting particularly attractive real yields right now in treasuries. And if the Federal Reserve starts to cut interest rates as they're planning to do, that's going to disappear even more. So the underlying level of inflation in the US economy is already well above what people are expecting. And what that means is that you've got to start thinking about seriously about monetary inflation hedges. Now, another thing that I've been saying, over recent months and years, is that you've got to distinguish as well between high street inflation, which is implied here in this chart, and from monetary inflation, which is always faster, because monetary inflation doesn't just feed the high street, it also feeds asset markets. And it may well be that monetary inflation is moving at a clip which is nearer 8 to 10% per annum, because that is the rate of growth by which debt is growing exponentially in the US. And if you've got debt, government debt in particular, growing at this clip, you're going to have to get liquidity rising at a very similar rate. And if liquidity rises at that rate, that's monetary inflation. So you've got to start thinking seriously about moving away from a 60-40 asset allocation towards something which is nearer, 60%, let's say, for equities, 10% cash, 10% bonds, conventional bonds, maybe 10% tips, and 10% in gold and Bitcoin. And this is a different asset allocation, but I think it makes a lot more sense in the world that we're entering.
Okay, thanks for explaining that. Yeah, it's really interesting to see the analysis that goes into it. So you don't think it's going to converge to maybe somewhere in the middle? You think that the tips sort of level is going to go up to the expected inflation level? Is that what you're saying?
Well, I think the bond yields are going to have to rise. I mean, they're being suppressed. I mean, how long can the Treasury do this? Well, it's doing it for as long as it can, which means it's issuing a lot of short-dated debt. But that short-dated debt is monetary inflation. Okay. It expands liquidity, it's monetary inflation. That will spill over into actual inflation in time. And so the inflation rate will pick up back from 2% nearer towards a trend of 3.5%. Now, that doesn't detract from the fact that it may well be in the next few months that actually reported headline inflation comes in below 2%. But that's courtesy of what's going on in China and the fact that the Chinese economy is exporting for its life, as if its life depended on it. And you're seeing price deflation in China because of the errant policies that the economy or the administration is following.
Okay, and do you see Basel IV? I guess it's a way for forcing banks to own more government bonds. Do you think that's something that's going to help the markets, or do you think it's going to create more distortions?
Well, I mean, it's going to create more distortions. Is it going to happen? Yes. Is it a way of financial repression? Yes. Is it going to lead to more inflation in the long term? Yes. Tick all those boxes. I mean, we've seen this. We've seen this record before, or this tape before. It's how policymakers respond. They change the rules. Basel IV tells us something because there were 3 other Basels before that, and each one increased the amount of debt, government debt, that banks were forced to hold.
Yeah, okay, that makes sense. So if we go back to, I guess, what we were talking about before, how you said that majority of sort of returns come at the start of the liquidity cycle. We've probably seen at least 2/3 of the returns currently. So would you say then the risk on is the play to go, or do you think there are sort of other cyclicals or other, I guess, assets that are going to perform better over the near term?
Well, I mean, we're still risk on. I mean, we've been risk on since October of 2022, and we're still risk on. I mean, you can trade around that. I mean, markets never move in straight lines, but I'm giving an investment strategy, not a trading strategy. And I think from an investment strategy which lasts 5 to 6 years through the liquidity cycle, that's exactly what you get. you're looking at periods of risk on or risk off that can last 3+ years. So we still think we're in a risk on environment, and everything that we look at supports that view. You've got the evidence is there in liquidity, the evidence is there in terms of the sectors of the stock market that are performing. Technology was the leader. That's pretty typical. You're starting to see the recovery in markets beginning to broaden out now. That's another feature you'd see. Around that time, you start to see evidence that the economy is bottoming out. That's what I suggest you're getting. You also see evidence that yield curves are steepening. You're seeing that. So everything we see seems pretty much in line. And what's more, as I alluded to earlier on, US dollar is beginning to weaken, which is normally something you see around this stage of the cycle.
Yep. Okay. And I know we haven't seen, I guess, maybe some of the base or industrial metals performing as well. So copper and, iron ore, those sort of commodities have had a bit of a pullback recently. Do you see them to sort of being a beneficiary of this continued liquidity cycle, or do you think China is maybe the economic factors there is weighing on their performance?
Well, I think the thing to do is to differentiate the impact that the Federal Reserve has on markets and the impact that the People's Bank of China has on markets. Now, China is muscling forward. It's more and more powerful economy and more powerful central bank, just because by dint of its size. But China's People's Bank has much more impact on the momentum of the Chinese economy, and because of China's large economic footprint, that means it has a big impact on the world economy, the real economy, and therefore on commodity prices. The Federal Reserve is still hugely powerful. There's no question about that. But it has its real power in financial markets because we're living in a dollar-based financial world. So if you start to see the Federal Reserve easing, that's going to impact financial markets. If you see the People's Bank of China easing, then you're going to start to see the impact on commodity markets. Now, there is some tentative evidence that the People's Bank of China is easing. In July, they injected a large amount of money into their money markets beyond what you would normally see seasonally. That has sort of continued a bit through August, but although I've got to say that the numbers are a little bit weaker than I thought they might be, but nonetheless, the trend does seem to be upwards. And so you would expect to see some stabilization in commodity markets over coming months. But I'd be a lot more confident of that if I saw more activity from the People's Bank.
Okay, that makes sense. And then you sort of previously talked about before about, I guess, gold and Bitcoin, how they sort of maybe don't correlate as much to equities, even though maybe we have seen that there has been a little bit of correlation recently. So is this just to do with is this to do with the dollar and inflation, or is this to do with maybe they're the best hedge that you have against this inflationary pressures? Because I'd say they have sort of correlated quite a bit with equities over the past few years.
Yeah, I think the thing to do is to differentiate Bitcoin from gold. Okay. Now, if you look at gold responds over the long term to the trend in monetary inflation. And gold has had a very successful track record of actually matching, at least matching, what you've seen in terms of the expansion in global liquidity. So let's take that as a fact. And it's certainly, gold has outpaced consumer price inflation by a large measure, and it's pretty much matched this expansion in liquidity. If you look at Bitcoin responds much more to the cycle in liquidity. It's much more sensitive. If you looked at the, if you like, the loadings or the sensitivity factors of gold and Bitcoin over the past 5 years, to take an example, gold has moved for every 10% rise in liquidity, gold has moved upwards or downwards by about 15%. If you look at Bitcoin, the average in the last 5 years has been about 40%. So there's a big difference. In other words, Bitcoin is about 3 times the effect that you would see on gold. It's very sensitive to movements in liquidity. And because liquidity also affects general risk assets like equities, therefore you see that correlation between Bitcoin and the equity market being borne out. Now, that's the experience we've had recently. Over the medium term, I would also suspect that you're likely to see Bitcoin similarly matching the trend in monetary inflation. Equities will do that as well, but the faster that monetary inflation trend, the more that equities will lag behind traditional monetary inflation hedges. So if you go back to the 1970s, for example, equities were initially a very good performer. But as inflation began to pick up, both consumer price inflation and the pace of monetary inflation, then you started to see equities lagging real assets and gold and commodities. And there's no reason to suspect that won't happen again.
Okay, that makes sense. So, Michael, thanks so much for your time today. Really appreciate it. Last question is, what is one message you'd like people to take away from our conversation?
I think the key message is that liquidity is the most important thing. If you haven't realized it by now, I mean, this is the fact. You've got to understand liquidity movements. That's really what's driving markets. And generally, what is behind this liquidity expansion, certainly in the current period, are central banks and ultimately governments. Governments need to fund themselves. The fact that we've got aging populations with very generous welfare systems, and we've got a defense budget which is likely growing, means that the ability to tax populations is de minimis, and therefore you've got to start turning to the financial markets to fund all this government spending. And the only thing you can do is ultimately to print money. And that is what is monetary inflation. That is coming to a high street near you, and you've got to invest accordingly. And therefore, watch liquidity, but start to move away from this traditional 60-40 asset allocation, reduce traditional bond exposure, and start thinking of dedicated monetary inflation hedges.
Great points. Yeah, and I really liked how you laid out sort of your thoughts on what a balanced portfolio should look like moving forward with these changes. So I appreciate that. But yep, Michael, thanks again. If anyone wanted to find out more about your work, where would the best places for that be?
Well, I think for the best place would be to look at our Substack, which is called Capital Wars, and that is brings both data and commentary to subscribers, and that comes out probably 2 to 3 times a week. If you want an institutional service, go to the website, which is crossbordercapital.com, or if you want the occasional comment or tweet, look at the handle @crossbordercap, which is on X, or what used to be called Twitter.
Perfect. I'll put that description below, but thanks again for your time.
Good. Thanks, Anthony. Enjoyed it.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.